Hi, and welcome to another Tax and Legal Debrief session. I am Stella Gustai, Director in the Tax and Legal Department of Deloitte Cyprus, specializing in international and corporate taxation. Today, we will focus on the main provisions of the EU Directive, introducing a global minimum rate of taxation for multinational and large domestic groups in the European Union. The EU Directive, which is based on the OECD Pillar 2 model rules, is expected to fundamentally change the core principles of the international tax landscape from 2023 onwards. On the 12th of December 2022, the EU Council announced the unanimous political agreement of all EU member states to implement a minimum tax and to transpose the directive into their domestic laws by the end of 2023. The intention of this directive is to ensure that large multinational groups, including large-scale domestic groups with consolidated revenues over 750 million, are taxed at the minimum effective tax rate of 15% on income arising in low-tax jurisdictions. So, in essence, in-scope groups will pay a minimum tax irrespective of where they choose to operate. This will be achieved through the application of two interlocking rules. The primary rule is the income inclusion rule, which imposes a top-up tax at the level of the parent entity in proportion to its shareholding percentage in entities that have low taxed income. Generally, the income inclusion rule is applied at the top level of the ultimate parent entity and works its way down the ownership chain, the so-called top-down approach. The second rule is the under-tax profits rule, which acts as a backstop rule to bring low-tax jurisdictions in line with the minimum tax rate when the income inclusion rule is unable to do so. Where the ultimate parent entity of an M&E group is located in a third country jurisdiction that does not apply a qualified income inclusion rule, member states shall ensure that its constituent entities located in the Union are subject to a top-up tax in the member state in which they are located for the amount allocated to that member state. It is important to note that, in accordance with the directive, member states have the option to elect and apply a qualified domestic top-up tax, which will be paid on low-taxed entities located in their jurisdiction. This is a very important development for jurisdictions like Cyprus, in which the effective tax rate is below the minimum rate. Such jurisdictions will have the option to top up and collect the tax in their own jurisdiction, rather than allowing a foreign jurisdiction to charge top-up taxes elsewhere. The directive requires EU member states to enact domestic legislation by 31st December 2023. The income inclusion rule will come into effect from 31st December 2023 and the under-tax profit rule from 31st December 2024. We do recognize that many businesses are likely to be impacted by the global minimum tax. Our tax specialists can help in identifying in-scope groups, perform impact assessment on jurisdictional basis, identify the jurisdictions that the top-up tax is payable, and assist in setting up compliance processes. So do reach out for a consultation. Thank you for watching.